Welcome back to the Machine of All Trades, Master of None. I'm the ghost in the machine, and the financial markets um, is where I operate. Okay, guys, I'm going to do an example with the 100, with the Volatility 151S index. Um, I'm going to do examples with the synthetic indices because I'm going to do an example with synthetic indices because it's December and in the currency, in the forex market, in the commodity market, in this market, and any other financial markets, there's low probability setups during the December and January months, but you can trade it. You can be profitable, but you have to lower your risk and other stuff. Well, guys, I am going to show you the three box strategy in the H4. I'm going to show you the three box strategy in our H4 time frame, and then continue going lower. I wouldn't start with the 24-hour. Why? Um, why? Because why? Because it doesn't look nice there. So we immediately see our break of structure where from this low there. So from that high, we went on to break this structure, which we imply that it was the low of the previous H4 uh, dealing range, because we broke structure there. We broke structure to the upside there. After we broke structure to the upside, we went on to break this low, which will be our H4 break of structure, to make a new dealing range. H4 BOS, boss, whatever you like to call it. That'll be our H4 break of structure, and yeah, and our dealing range low, no, our dealing range high will be from that high to that low. Why that low and not this low? It's that low because since we came from that top or that higher low, we went on to break structure and continue bearish without breaking any structure to the upper side. You see, and as I told you guys, a three box strategy. We're going to first identify our displacement leg, which in this case it will be this one. After identify our displacement leg, for sure, the displacement leg that we would have identified would have broken some um, old slow or structure. Maybe we've gone like this, you know, for example. And after identifying our leg, which would have been this one, we are going to anticipate our retracement level, our retracement phase, or pullbacks to our areas of premium levels, because when we are bearish, we want to retrace back to our premium levels to go by there. The moment we start entering our 50% of that um, equilibrium level to the upper side, to the upper premium levels, we are expecting the market to start sailing, to start breaking structure to the downside, showing its interest to go bearish, aligning with the H4 structure. So we are waiting for this. And the moment we have our break of structure to the upside, we will immediately start labeling our dealing range low, which will be this one, right? And that will be our dealing range high. Yeah, whatever. That'll be our dealing range high. Yeah. So the reason why I labeled this as our low is because we had this break to the upper side here, and hence I labeled this as our dealing range low, of which now you will realize that here we broke structure with our with the candle bodies, full naked candle bodies, right? We broke a structure there. After breaking structure there, we anticipated that this would be our new structural dealing range low, and this will just be a break of structure, the H4 break of structure, BOS. And hence our dealing range high would be the level or the higher high or the higher low that would have mitigated, or that would have retraced. Got the high, the last high that it made its retracement and started falling. That would be our dealing range high. English is very hard. Technical English is very technical. English is also very hard. I don't know now. Yeah. And internally, what we can see that we had our break of structure in the internal, in the H4 internal. Okay, we had our break of structure here. There, that's where our break of structure was, and hence that would be our dealing range high, dealing range low, and I will label this as our dealing range, no, as our protected high, because we don't expect price to come there. If it comes there, that means that there will be a break of structure to the upside, hence the market will eventually want to go to the upside in our H4. But since we are bearish in our H4, as you can see, we are looking for price to come mitigate the area of premium levels to the upper side and then go target our lows, our weak lows, right? So internally we had this break of structure, and what you might realize is that in this internal break of structure, will realize maybe this was the 15-minute low, 50-minute high of the dealing range of that 50-minute range. But let's not be quick to label that, and let's focus on our H4. So from that high to that low, this will be our dealing range, low. No, thinking at the 50% of that level will be our dealing range equilibrium level, and above that level will be where we anticipate that will be where we're anticipating for the algorithm to reprice the price lower to target our protected low, to target our weak lows. Let me label them. That's our weak low, and this is our protected high. I forgot to mention that there's an H4 protected high and an H4 weak low. Okay. Above our premium levels, we can see that immediately we had this red candle as our supply zone, as our first PDRA, or as our first premium level to reject from. There'll be our first supply zone, and this will be our second supply zone. We label all the supply zones that are on top of that. This is the supply, another supply zone. The problem is it's mitigated. It was mitigated by this retracement here after this break of structure. After every break of structure, we are anticipating a retracement back to an area of point of interest. And also we had this demand zone, supply zone. I told you how to find supply zones. Supply zones are found by an inefficiency below it which hasn't yet been mitigated. No, which the candle has been. Once we see an inefficiency below a candle, we are going to see that candle as we're going to identify that candle as a supply zone, especially after it has, more especially if it broke structure. Once it broke, is the one that has broke structure, we're going to label that as a supply zone. This supply zone also broke this structure. This supply zone also broke this structure. So it's an obvious case. So this will be our unmitigated, because we are targeting only for, we are targeting only for unmitigated supply zones in this area to sell from. Let me label them quick so that this video doesn't be long like the ones that I created. Okay, we label that dealing range. Let's take it off. Okay, let's go to the 15-minute now. In the 15-minute, what you are going to realize is that let's go from this too much. What you're going to realize is that we had this 15-minute break of structure. We firstly had this 15-minute break of structure here. Because in the H4 this is not identified as a, let me check first. Let me pick it. Let me pick something real quick. Well, that was a break. That was just a liquidity grab and not really a break. So I wouldn't have labeled this as my retracement, the start of retracement of the H4, but I would have labeled this one as the retracement of the H4 because it broke structure with a full body. So going back to the 15-minute, we have confirmed that this wasn't an H4 internal break of structure to prepare for retracements, and currently we are here. We are there, and here we figured out that we had breaks of structure to the downside. You see, the moment we had that breaks of structures to the downside, we would have realized that, you know, this dealing range